Welcome to the next video. Well, in the first video, we talked briefly what is markets, how it works, and just a brief introduction, basically. So now let's dive deeper into what actually makes trading profitable, and just as important, what causes most beginners to lose money. I'll explain key trading concepts, show you how profits and losses happen, and help you avoid most common beginner mistakes. So we had a great comment in the description that asks basically what is supply and demand. So I'm going to explain that as well, and let's jump right into it. Let's go. So most basic way traders make money is simple: buy low and sell high. So that is the term called going long. When people talk about they are long the market, it's basically they bought here, they want price to go up to make money. Right. So, and then we've got the term short. You want price to go down. So you sold here, like in the previous video, I've explained the dynamics and the structure in terms of how a short happens. So you want price to go down to make money. All right. So those are the two ways. Either you go long or you go short, or you do nothing. So three options. Sometimes it's a good idea to just sit on your hands. So that's also, some people call it, you are also in a trade. Basically, you're not investing or not trading in the market. So long, short, or nothing at all. Okay. So I'm going to quickly just take my face out of the way here, and then we are talking about supply and demand. All right. This would be the price levels. So we've got $200. Then we've got $300 here. Let's say 250 in the middle. I'm going to draw a chart. And then we've got time basically here. So again, we're going to talk about shoes. Try and explain supply and demand in the simplest way. This is basically a chart. So if I'm going to draw, let's say for example, this is where we are currently priced at $250 for a pair of very expensive Nike shoes, and there's no buyers and no sellers, for example, in the marketplace. So price won't move anywhere. We don't have sellers, we don't have buyers, so price is going to just stay at the 250 level. All right. So let's say, for example, we get demand for these shoes. So I'm going to do this. So this block, we've got a demand. Someone wants these shoes at $200. This is showing that we have some interest in the market at this price level. So you can basically see the depth of the market. That's why they called it the dome. So this would be, I'm just gonna type it here as well. It's called the dome, which is then the depth of market. So you can see the full depth of all pricing, and where's some interest, some supply and demand. Supply would be here, demand would be at the bottom. So this will be, apologies, demand. Okay. Now this would indicate, why would price go down to demand? If someone actually wants to decide, okay, great, I'm gonna sell my $250 shoes. It's fine. I'm just gonna get rid of it. I'm gonna sell it. We have some demand here at 200. Let's just sell it. So what happens is, depending on how much the demand is here. So let's say there's a 1,000 people that actually want the price here. And one of these shoes gets sold here, so that the price chart would then basically just go down here and a transaction would happen place at the 200. Okay, so that's why price is, for example, trading here, and that's why it's being traded there. But let's say this trader or this person owning the shoes, they don't want to sell at 200 because they see the big demand here. This demand is very big. It's growing basically. A lot of people interested in the price there. Then also we can see some demand here at a bigger price, a higher price again. Now, why would you go and sell your shoes if the price seems to be trading higher? Someone wants to actually trade at this level. Again, this is called demand in the market. That's why price is moving upwards. You can see a lot of people want to buy shoes at these levels. It's basically pushing the price, the trading price higher. This line is indicating actual transactions happening. If nothing is trading, that's when there's a gap in the market. There's sometimes just last traded would be here, and then all of a sudden it's trading here at this price because someone, for example, put in a big demand, an order to actually, I want to buy here at, let's make it 250 because I want to indicate the supply side as well. And now that's the next trading price. So that's why there's a connection here between these two. Or sometimes it's called a bit of a gap. But anyways, this would be the price chart where it's trading. This is demand, just going higher and higher. But you can see the full depth in this case. Now, going to the sell side of it, the supply. If there's a supply at 300, so basically a lot of people owning these shoes, they put in some orders in the market at a price level of 300. This trader or this person that bought for 250 way back here can see there's a lot of demand at these price levels. So they put in a sell order, the supply at priced at 300. Now this would be their supply. Depending on the number of demand and the size of the supply and demand, that's why price is moving up and down depending on how much the supply is here. If we have a lot of demand here, let's say thousands and 500 and 300 and 200, for example, people wanting those shoes, and the supply here at the top is only 50. The probability that the price would just go up and up and up more aggressively is higher, because someone is just going to buy at 300 hoping for these demands. Let's say, for example, this person decided, okay, you know what, I'm going to rather put in my demand here because I'm not getting my shoes at the price of 200. I'm just going to move up my demand. I'm going to move it higher because I can see there is some stock available at $300. I'm going to try and get in at 280 or 290 price, and or I can just take it at 300. taking out that supply, for example, and move the demand. So it all depends on supply and demand in the market, where price is likely to move. Okay, so if there was nothing in the market, like I said earlier, if there is no demand and only supply, let's say this happens after this price movement. This was the price chart, okay? Now, all of a sudden, we get a lot of people, because it changes the whole time. The market changes, and we see this. And we see this. Someone is just starting to sell these shoes. There's no interest. No one wants these shoes. It's outdated. No one is interested in. And you can see there's a big supply at 250. The probability that the price is just going to quickly drop here and start trading at these prices or even lower, because it depending on the size of the transactions, the size of the supply here. And when you take out all of these, take out these boxes and stuff, and you can only see a line chart or a candlestick chart. This is what you can see. Now, I know some people in social media, they talk about, oh, okay, you know what? This will indicate that we had a big, I would say, a big supply over here, because that's why price moved around, turned around. It's likely, that's likely the reason. Yes, I agree with that, but there's no sure, I would say, proof that there was a big supply there. So it's just an I would say an idea, basically, that that there was a big supply in that area. So you can't be exactly on the dot, I would say. I just want to get a price. Sorry, apologies for that. You won't say the supply was exactly at this price level of 300. It's just a indication of more or less it could have been in this area, or it could have been here at 320, for example, at price 320. And because of that, traders got scared and started selling before the actual trading of that specific supply area. And sometimes when you open Bookmap, that's one of the softwares you have, you can actually see these levels at a specific, very specific price point. You can see there was a big seller or big supply. This is only an order in the market, so it actually never traded, for example, or it started trading that level and the supply started growing, basically. All right. That is supply and demand. So I'm going to move forward and explain some of the key concepts, basic terms that a trader needs to know. I'm going to start here with the Nasdaq. So if you go to the CME Group website, you can find, I'm going to specifically focus on futures. So when you go to markets, you will find different markets you can trade. For example, I'm going to focus on the NQ, the E-mini Nasdaq 100 index future. Okay, so when you go to specs here, so this is the code, the current code for this quarter. I'll explain quarters shortly. Just wipe out this. Okay, so moving on to the reason you get different codes, but this is in a year, so we get 4 quarters basically. This is the March June, September, and this would obviously be December contract. So you get different codes. So currently we are in the NQM5, so that indicates the June contract. So you go to quotes, NQM June 2025. So currently we are trading this contract. Yeah, the June one. So we are in May at this time period. So we're trading this end of this quarter, this contract. You can see if you go to the website here, you can see the volume trading here. 49,365 contracts that traded for the day so far. It's obviously going to increase, and next day it's just resetting to 0, and then we can see the next day's volume. This is the opening price, high price, the low price of this day. Okay, so you can see that we're starting to trade the next quarter, September 2025. That's the code NQU5. So only 55 contracts traded. At the end of this quarter, yeah, people are going to start trading this, the September one. So obviously going to jump over, and then we're going to start trading the September contracts. All right. This is just basically just ending. Gets scratched. All of this has been finished trading. So that's it. It basically just settles at a specific price, and then we start trading the next quarter. All right. So I think all futures are trading like that. So you can see these are the future contracts that's going to be traded. And nothing is currently trading there. And then going to the specs, talking about a contract size for the Nasdaq NQ. So we have things called ticks and points in the Nasdaq. So we have 1 point we've got equals 4 ticks. 1 tick is 0.25 points. Okay, that's how the NQ is structured. So you can also find it, the value of this, the $20 per index point. That's the value of one contract. When you buy one contract in the Nasdaq, this will basically happen. Your price, your money in your account will move up and down. For every single point it moves up, you will see an open P&L of $20 upwards movement in your account. So 0.25 index points is basically $5. For every single tick the market moves, will be $5. Right? There's a lot of information here, but it's not really necessary for now. Quarterly contracts, you can see it March, June, September, December, and then yeah, that's it for now. And it's trading almost 24/7. You can see the time it trades, starting at Sunday 6 p.m. Eastern time until Friday. Then we've got a daily close between 5 p.m. and 6 p.m. Eastern Central Time. That's the only time the market is basically, this market is closed. So there's a lot of markets, like in the previous video I've explained. We've got gold, a lot of forex markets as well, and crypto and stocks. So every single market or instrument you look at have these specifications basically. So you need to look into it. So in terms understand the market you trade. That's why it's better to start with one instrument or one market and trade it like that. So then we have jump into a chart. So this is TradingView. Like I said previously on the previous video, this is, you can do some paper trading or demo account trading in this. So we are currently on the NQM 2020-25. That's the June contract. And this is a 1 minute chart. I haven't explained candlesticks yet, so we can do that also. I'm going to do it now before I jump into the chart. Let's draw a, usually a candle looks like this with a wick there and a wick there. Okay. This thing indicates either a 1 minute, a 5 minutes, a 1 hour, or a daily time period, depending on what your settings is on the chart. In this case, this thing is a 1 minute. Going back here, the reason why it's green or red is if it's, in this case, you won't be able to know where price actually opened and closed in this minute. Okay. So if it's green, let's say this thing is green, it means the closing price is here. Okay. That's the closing, the close price of this minute. So the last transaction or trade that happened in this minute was at this price level. Okay. Would give you a price level. This wick was the high in that minute. So everything happened up and down here, and this was the high, also a price. This would be the open, and this would be the low. Okay. If this was a red thing, red candle, I'm gonna just do this. The open and close would be swapped around. Okay. This will still be the high, still be the low. If this thing was red, this would be the open. And the close would be down here. That's why it's red. The actual close was lower than the open. If the close was higher than the open, it would be a green candle. Okay. But the high and low is still the same here. All right. And this could, like I said earlier, this could be any time frame candle. Okay. So going back to the chart, that's what all these price movement happen in a single minute in this case. Okay, so when you go to paper trading, you can choose your account, have a reset your account, you can have leverage on your account. Meaning, what is leverage? So leverage is basically you put down a small amount of money and you borrow the rest of the money from the broker. This is the exchange. This would be the, either it's when you're trading stocks, for example, this would be the New York Stock Exchange, NYSE, and then we've got different brokers connected to this exchange. we as traders or retail traders or anyone is plugged into this broker, which is then, for example, interactive brokers or Ninja Trader Brokerage or Dolman Trading or whoever is your bank that's plugged into the exchange. All right, you can't trade directly on the New York Stock Exchange, for example. So this is a trader that sits here. These guys give you leverage to trade on the exchange. Now, every single broker have different requirements for you. So if you put down $1,000 in your brokerage account, you can get leverage on that if you trade intraday or if you trade overnight, depending on your broker, the risk tolerance they have for you as a client. If you are typically it's very uniform between all the traders, but if you are a very high-end, high net worth trader, you're probably going to get better rates from these guys. And you can go and shop around from different brokers. Like I know AMP Futures also got great rates. Webull is one of them. Interactive brokers, TD Ameritrade. There's a lot of brokers in the TradeStation as well. So, but you can get leverage on that. So I'm going to show you here available funds. So this is a paper trading account. So available funds, $5,000. But you can see this thing is priced at $21,440. The price of one Nasdaq. So because I get leverage, 200 times leverage on this, that gives you 5,000 times 200 times leverage, $1 million worth of buying power I have. So you get leverage. Okay. So I would be able to trade a lot of contracts with that. So divided by 21,443, 46 contracts I would be able to trade with my $5,000 worth. But because of leverage, you can lose a lot more money. That's exactly the same with when you put down a small amount. I'm going to show you now. So even if I buy one contract, if the Nasdaq goes to zero, if price goes to zero, I'm going to lose 21,442 times the value of one Nasdaq point, like we found out on the CME website. So 1 point is worth $20, so times 20. That's $428,820 I'm going to lose if the Nasdaq goes to zero. Okay. I'm going to show you guys here. Let's buy. I'm going to. So because it's a delayed data, I'm going to do the transaction. This is not exactly this right point, but okay. You will see now. So I bought. I'm long on Nasdaq. I'm going to put in a stop loss. If price goes to this, I'm going to zoom out, but I'm going to lose $1,000 here at this price point. If price goes here, I'm going to lose $1,000. The account margin, currently my margin rate on this paper trade account, it's I've got my 200 leverage, 2 times 200 leverage. My margin, the money I need to put down is $2,144 to have one contract long. But you can see I'm going to lose. That's the point where I would lose $1,000. My account would be wiped if it goes here. 5,000. Sorry. That's my stop loss. At this point, we're going to lose everything. For example, yesterday, the market, the low of yesterday was at this price point, 21,200. You can see. So if price goes back to yesterday's low, I'm going to lose the account. $5,000. I'm going to lose everything in this account. If you buy one Nasdaq. All right. But it also applies to the top. If you put in a take profit, if price goes higher, you're going to make money because I'm long. I want price to go up, obviously. Okay. But this gives you an idea of what leverage can do. The actual, if there was no leverage involved, we could have held this position. That's where investing, it's not leveraged. So it probably would be, if you buy the outright, putting down the full, I would say, I'm just going to make sure the trade value. Yes, the trade value at the bottom here. So the trade value is 428,930. That's the full US dollars you need to put down in your account and hold the position. And you won't be able, if you won't wipe, then the only reason where you're going to wipe your account is when price goes to zero. Okay. Okay, so here's the part where most YouTubers won't tell you. Most beginner traders lose money, especially in the first few months. And why? It's over leveraging, risking too much to chase fast gains. So I'm going to jump back into the chart. Exactly this point. If you only have $5,000 in your account and you want to buy one or two, and you actually can buy two contracts here. If you buy another one here, that's $5,000 gone. And you can see the account margin. You can actually buy two contracts and you're going to lose your money here. Over leveraging. So then we've got this thing called no stop loss. That is basically just removing this. Then we've got things like no plan, just jumping into trades based on feelings. So plan your trade and trade your plan. These habits are account killers and they're all avoidable with the right education and mindset. So successful traders approach the market like a business. They treat each trade as a calculated decision, not a gamble. They risk a small percentage or per trade, often just a percentage or 2, or even 5%. They always use a stop loss, define their take profits, they journal their trades and learn from every mistake. And most importantly, they know trading isn't about winning every trade, it's about being consistent over time. Now you understand the basic mechanics of making and losing money. Next video, we're going to explore something that could change the whole approach. How to trade with someone else's money through a prop firm. So not risking your own capital, but you're trading companies' money. I hope you enjoyed this video. If you have more questions, please leave it in the comments below and I can hopefully address those and explain it in depth for you. And yes, I hope you enjoyed this video. See you in the next one. Cheers.